My guest today is Michael Yardney, CEO of Metropole Property Strategists. Michael has been voted as one of Australia's 50 most influential thought leaders. He's an author of 9 books, host of Michael Yardney's podcast, and many consider him as one of Australia's leading experts in wealth creation through property. Michael, welcome to the show.
Thanks for having me, Nathan.
Now, Michael, there's a lot of news out there. We're seeing downtrend in the property market continues. Buyers and sellers' confidence wanes. We're actually starting to think, have we seen a once in a generational price hike for properties? And are we at the peak? Will we never see this happen again? What are your thoughts on the market and what we're seeing at the moment? We're seeing a little bit of negative media. The AFR with an article recently saying they're predicting prices to fall by 25%. So we'd love to get your thoughts.
Well, boy, there's a lot of questions there. So let's start with, did we have a once in a generation boom? Yes, we did. And we won't see one like that again. In other words, such a big rise in such a short period of time for a long time again. It was a perfect conglomeration of pent-up demand, low interest rates, government incentives. And last year in 2021, the Australian property market went up by $2 trillion. That's a number that's just too hard to fathom. In other words, the total Australian property market's now, with residential market, about $10 trillion. And now we're getting back to normal. It wasn't normal last year, the year before. You could buy any property, go away on holidays, not that you could, and if you came back, all of a sudden, it would have gone up in value. Now the market has slowed down. In fact, when looking back, we'll see that the peak of the property price growth was last year. Already Sydney and Melbourne property values overall are falling, but there's some good areas. And Melbourne and Sydney, sorry, as I said, are falling, but Adelaide, Brisbane and Perth are still rising. So we're in a more normal, a fragmented property market. But yes, you're right. Those headlines are scary. Now, you missed out the big one. One of the big commentators in the Financial Review has even suggested property values are going to drop 30%. And that's made people scared. So I'd love to have a bit of a chat with you and unpack some of those predictions. And if I could also give you some reasons why I don't think that's going to happen.
That'd be great, Michael. We'd love to get your views on that. So I guess maybe unpacking it a little bit further on where you're seeing properties maybe going in the next 12 to 24 months. And maybe even if we have a 2-tiered economy, I know if we cast our mind back maybe 10 to 5 years ago, Sydney and Melbourne was going crazy. Well, Brisbane, Adelaide, Perth, had moderate growth, and we had investor cap limits where the lenders could only lend up to 10% of their books for investors. Now we're starting to see the opposite. We're seeing CoreLogic's recent data suggests that Adelaide had a 2.7% growth, Brisbane as well, some growth there, as well as WA, while Sydney and Melbourne going backwards. So what do you see things happening in the next 12 to 24 months?
Well, maybe it's worth going back a while before we move forward, because we at Metropole have done very detailed research and seen that since the Australian Bureau of Statistics figures have been kept, and that's going back 42 years, the Australian property market, and there isn't one, but if you look at it overall, has gone up 540%. Melbourne's been the strongest city to have capital growth of about 8% per annum compounding. Sydney and Brisbane a little bit less than that, and they're 7%. But that was, we've had wars, we've had recessions, we've had high interest rates, we've had low interest rates, we've had multiple governments. So the property markets in Australia, in fact, since Federation, have kept rising. And there's a number of reasons for that, but they don't rise continuously. So there's periods when the property market goes up, then it flatlines for a while, say some property values go down. So I'm a realist, and what we know is facts and figures. And so that's what we should look at, and evidence rather than speculation. See, Nathan, there are 25 million property experts in Australia. Everyone's got an opinion. You know what they say about opinions, they're a bit like belly buttons. Everyone's got one, but they're not really useful. So you've got to be careful who you listen to. And if we just go back 2 years to the beginning of the pandemic. The same headlines we're reading now were then by much the same people. And I'm not saying the long-term property pessimists and the naysayers, but the bank economists and the same people that are getting the headlines in the paper today said that the property market was going to drop 15%, 20%. Remember, there were fiscal cliffs we were going to fall off. There was going to be 11% double-digit unemployment. There was going to be a cliff we fell off when fixed interest rates moved to variable, another cliff we were going to fall off when unemployment got high, or when all those COVID relief packages were removed. None of it happened. And I believe much the same at the moment. The people predicting a property market crash are basing it on one factor. Interest rates have dropped, and therefore given people extra serviceability, affordability, and because of that, property values went up, and that's true. But now they're saying when interest rates go up, the opposite will occur. Properties will be less affordable, and therefore property values will drop. And the answer is wrong. It hasn't happened before, and the statistics show that, but it's much, much more than interest rates that underpin property values. So for property values to crash, like you were mentioning, like the headlines are suggesting, and again, coming from people who should know better, for a property market to crash, we need people to have to sell their properties at almost any price and nobody there to buy them, so they've got to give it away. Now, I'm not suggesting property values won't fall. They are. In the upper end of the markets, particularly in Melbourne and Sydney, the trophy homes, the top quartile is not selling as well. But if you think about it, you don't need a $20 million trophy home in Double Bay or in Brighton when a $15 million home is going to do. So people are not upgrading. And people who are hoping to sell their houses and get $10 million now all of a sudden have to accept $9.5 million. Doesn't mean that their property value has fallen. There's not as many sales at the upper end. At the other end of the market, there's no doubt that some first home buyers have overcommitted. Some investors have borrowed a bit too much. But in general, there are very few poor performing loans, and you'd know that being a very substantial mortgage broker, and you'd see it amongst your clients, and you'd see it amongst the bank statistics, that in general, there isn't a lot of distressed selling. See, for property values to crash, as I said, people would have to give them away. But buyers are sellers, sellers are buyers. So if they've got to give it away, they've got to move somewhere. There's nowhere to rent. Rents are going up. And where are they going to buy? So there are no distressed sellers. The worst combination, of course, Nathan, would be high interest rates, high inflation, and unemployment. Because if you haven't got a job, if you can't keep your mortgage payments up, then you may have to sell. But at the moment, okay, people are scrimping and saving. That's what the government's, what the Reserve Bank's trying to do, stop us spending to stop pushing up inflation. But people would rather eat Maggi noodles than sell up their homes. So I can't see, long-winded answer to what's ahead, property markets crashing, but I can see discretionary sellers pulling back. They're not going to put their homes on the market. They don't have to. And yes, some are still going to have to because life moves on. People die, people get married, people have babies, maybe not in that order. But basically what happens is eventually greed will overtake fear. At the moment, fear is holding people back and the market's going to move on again. But I can see segments of the market falling up to 10%. But Nathan, we only have to go back to 2018, 19, when the Sydney market fell 10%, look where values are now.
100%. Yeah, 100% couldn't agree with you more. And I think there's a few things you said there, Michael, which I think are quite relevant. Rents we're seeing in some areas have gone up 15, 20%. So, people are always going to need a roof over their head. We know that, the principal place of residence for many is that thing that they're going to scrimp and save and do everything they need to do to meet their commitment. So I think that's really important. One thing that you kind of unpack there that, makes it a crucial thing to, that oversupply coming on the market. And there is that subdued availability of land and properties becoming available for sale and even through land releases. So I think they're all things that are quite important to keep in the back of your mind. I guess for those out there that are thinking of getting in the market, how do they know where to find a property that is potentially going to outperform the market average?
Well, that's a good question, because currently, I believe it's consumer sentiment that's holding people back. So what's currently happening is, well, a year or two ago was fear. We know fear and greed drive our market. So fear of missing out was the big fear then. Today, it's actually fear of getting in early and maybe seeing the value of your property fall. But what you asked is the good question: how do I find something that's going to outperform the averages? And that hasn't changed. And it doesn't matter whether we're in boom markets or slower periods now, because what we're finding at Metropole is that probably less than 4% of properties on the market are what I'd call A grade or investment grade properties. So it's actually still, those sort of properties are still being quite highly sought after and selling well. The thing is that, as I said a moment ago, discretionary buyers don't have to sell, so they're holding back good properties. Why would they sell at uncertain times like this? So in my mind, the right time to buy a property, I guess the old saying is 20 years ago, when's the second best time? Now. But the right time should have nothing to do with what's happening in the market, but should have more to do with your own personal circumstances and your financeability. So if they see you and your team and find that they're able to have a loan sufficient to purchase what we call an investment grade property and have some financial buffers in place to ride the ups and downs of the interest rate cycle and the property cycle, at the moment when there's less competition, it's actually good to find the right sort of property that when you look back in 10 years' time, the circumstances of today are not going to be important. They're not going to matter. It's not going to be a worry. So how we find properties that outperform the market starts with what I call a top-down approach. Basically, we look forward. A lot of people do their research looking backwards. What's been the biggest growth factors? Where has capital growth occurred? What's going to be the next hotspot? What we look for is areas that are going to outperform the averages because people can afford to pay more. And that has to do with demographics and wages. So we look for areas where there's going to be economic growth that's going to lead to wages growth, jobs growth, employment growth, people coming to live there, people being able to afford to pay more. And that will eventually lead to higher rents and higher property values. Because I believe as an investor, you should be investing for capital growth. Residential real estate's a capital growth investment. And for those looking to buy their home, for most people, the home they're going to buy now isn't going to be their forever home. So it's the stepping stone. So again, looking for capital growth where you've got, as a homeowner, tax-free equity growth that you can refinance and buy your next home. So we start looking at how's the economy going. And Australia's economy is still doing well. It's the envy of most other developed countries. Yeah, we're going to slow down a bit. The Reserve Bank wants us to, but we see, okay, it's not a bad time. We're not going to have a recession. So step one, not a bad time. Next, which state's going to outperform the averages with regard to economic growth, wages growth, and therefore bring population in? And we know the borders are starting to open up, so it will be our three big capital cities, Melbourne, Sydney, Brisbane. And I don't fight the big trends. So yes, there are some regional areas that are going to do better than the poorer performing suburbs in the capital cities, but most of the migrants, most of the higher paying jobs are going to go to the capital cities. And so therefore certain hubs of Brisbane, where you're based in Melbourne, where I'm based in Sydney, are going to be where there's going to be jobs growth. And we look for higher skilled jobs growth. So we're not looking where there's no disrespect to people, where the baristas are going to go and the gig operators are going to go. We're wanting people who can afford more and are prepared to pay more to buy properties. So we look at the state, then the suburbs, then within the suburbs, we look at the right locations within the suburb. You know, in your own suburb, there's areas where you'd want to live and areas where you wouldn't, and then the right property, and then price. So price is right down the bottom of the list on purpose, Nathan, because the price is important, I guess, three times. Number one, when you buy a property, you don't want to get it wrong. You want the valuer to value it so you can settle. Number two, when you want to refinance in a few years' time, And then again, eventually when you sell, but in between, it's not as important as getting a quality asset. So we look at buying what we call investment grade properties. Long-winded answer to your question, it's a property that will always be in strong demand in all market conditions. So currently there's a flight to quality. Last year, the year before, people bought anything. They made compromises just to get into the market. Now they're being more careful. That's good. So an A-grade property, an investment grade property, will have wide appeal in all market conditions. And what makes it in one area an A-grade property isn't necessarily the same in a different demographic area. And they're not just in higher, more expensive suburbs, but they're basically the sort of property that's got a wide appeal to owner-occupiers. So even if I'm thinking as an investor, I want owner-occupiers to want to own that property because I'm not going to sell, but they're going to buy similar properties around me to push up the value of my property. I like a property with a high land to asset ratio. It's the land component that increases. And so therefore, I don't mind townhouses and I don't mind family-friendly apartments. I own a number of blocks of apartments, but the answer is it's the value of the land underneath that's important. That's why we don't buy high-rise buildings. We don't buy for clients. Metropole, one of Australia's largest buyers agents, and we never sell property, but we purchase properties where there's a high land to asset ratio. We like properties with scarcity, something a bit special, something a bit unique, something a bit different about it, a twist. And my strategy, interestingly, is one where I like adding value. So I tend to buy old houses in the best streets, pull them down and build 2 townhouses that I keep in the long term, or a number of blocks of apartments that I've refurbished and renovated. So during this market cycle where, part of the cycle, where the market's a bit flatter, why not manufacture your own capital growth and rental growth by doing a kitchen or a bathroom renovation? Because the sort of developments that I do and we do for a lot of our clients are not for everybody. You need more money and you need a bit more expertise. So there are some fundamentals to follow, Nathan, to find those sort of properties that you asked me about.
Definitely. And I like the idea that it's about not timing the market, then the time that you're in the market. Because as you said, the best time was 20 years ago, and it's all about getting in the market and holding on. I think I got some really good tips in there about your strategies and how you help clients find properties. Now, do you find when there was that fear of missing out in the marketplace, properties were moving quicker, it was more about top dollar was winning the deal at the end of the day back in the boom. Now we've moved more probably towards a buyer's market. Are you finding with the clients you're helping and getting deals across the line, it's giving you better leverage than what we previously saw in those boom times, and you're able to get better deals across the line for your clients in the right areas?
Well, we still do the homework and the research, the due diligence for the area and the location. And interestingly, it's not just the people who own and buy in that location. It also makes a difference to tenants, because if you think about it, as investors, your future income is going to be dependent upon your tenants' ability to keep paying higher rents. So we spend a lot of time looking at the demographics of an area where people, as I said, aren't a week or 2 away from broke and can pay more. So interestingly, in those areas, there is still a shortage of A-grade properties, of investment grade properties. So yes, one doesn't have to make as quick a decision, but I know even last weekend, our buyers agents team missed out in Sydney and in Melbourne because we're, I guess, being a little bit more cautious. Sure, last year, the year before, you had to pay more than the next person. You had to go to auction knowing the only way you're going to buy the property is pay more. Now, again, we still take a long-term view, but we've got to be a little bit more cautious. But you've got to do more due diligence. There is a little bit of more time on our side, but again, there's a shortage of well-located properties. And that's actually seen when you look at figures like the monthly CoreLogic data. Vendor discounting is still very low. Time on market, how long it takes to sell properties in general, is still on the low side. So good, well-located properties are still selling well, but B and C grade properties, they're languishing on the market at the moment, Nathan.
Definitely. No, awesome to hear your thoughts there, Michael. If our viewers out there are looking for you, how do they find you and how can they get in touch?
Well, I have a daily newsletter property update that last year was read by 2.7 million unique readers. So that's a huge part of the Australian adult population. If you're interested in property, go to propertyupdate.com.au. And my company, Metropole, gives strategic property and wealth advice, metropole.com.au. And as you mentioned before, I have a podcast too, the Michael Yardney podcast.
Awesome, Michael. We'll really appreciate your time today. Did you have any other final thoughts?
Well, maybe before we finish, it's worth just reassuring people because of all the negative media. So if it's okay, can I share a couple of reasons why I'm not believing those naysayers?
100%. Would love to get your opinion and your feedback.
So as we said before, it's not just interest rates. So what one has to look at is the facts rather than the emotions. So the first fact is that currently this average Australian is wealthier than they ever have been. And these are not my figures or your figures. They've come from the Australian Bureau of Statistics that said that during the lockdowns, Australians stashed away about $230 million worth of assets in their offset accounts and their savings accounts, and they're now starting to pay them down a bit, use them up a bit, and that's what's causing inflation, because we felt locked up a bit and we want to spend more. But we're in a good position moving into this downturn not to end up having to sell up our homes. So there's a lot of talk in the media about how high our debts are, and they are. Overall, the debt's never been higher. But in the Australian property market, as we mentioned a moment ago, that's worth $10 trillion. And there's only $2 trillion worth of debt against all those properties. Only $2 trillion, a lot of money, but it's a 20% loan to value ratio. 50% of homeowners have no debt at all. People who've been around for a while, owned their home, paid it off. A lot of other homeowners, Nathan, have actually paid off a portion of their homes and the property value has gone up, so they've got a lot of equity. So overall, Australians are feeling pretty wealthy. And there's no sign of mortgage stress. Again, only today, I saw an article about how mortgage stressed we are. And what they do is they look at see who has got outgoings for their mortgage about more than 30% of their income. And that is the definition, I'm not sure who came up with it, of mortgage stress. But that doesn't mean you're in financial stress. Sure, people are going to have to pay more for their mortgages. Many have got money set aside in their offset account. Others have paid their mortgages in advance. But as I said before, people aren't stressed. And when you look at the bank, financially stressed, because when you look at the bank statistics, and APRA watches it carefully, Reserve Bank watches it carefully, you as a mortgage broker have all the research that you know shows that there are very, very few loan defaults at the moment. People are not in trouble. The interest rates, they're low. Yeah, they've gone up, but they're still lower than before the pandemic started, and they're going to go up higher because they're still too low. They're stimulatory. The Reserve Bank probably should have pushed them a bit harder than they have, started a bit earlier, pushed a bit harder, and they've got to get at least to neutral. And that's probably going to happen by the end of this year, 2022, and probably even have to go above a bit to slow us down. And then probably next year, the Reserve Bank's going to lower interest rates. But the point I'm making is that overall interest rates are on the low side. But we also know that the banks have been very cautious. As a mortgage broker, I do not envy you in your job. You would have had such a difficult time getting everybody's information, making sure everything's okay, making sure that your clients were not overcommitting themselves, and then being sure that they could borrow if interest rates went up another 2 or 3%. And so, yeah, interest rates are going up, but anyone who borrowed over the last couple of years, they've already been stress tested to make sure they could cope with that. And the real test is, in the past, rising rates didn't make the market fall. Strong statistics to show that that wasn't the case at all. Sure, price will grow, growth will slow. What tends to make property values fall is what happened in 2017, 18, where there was a credit squeeze. It's the flow of money that slows down that causes problems. But the moment causes properties to go down. But at the moment, the real underpinning factor is supply and demand. We don't have enough properties. Rental vacancies are so low that rents are going up very high. More people are coming into Australia, and we can't build, we're not building enough properties for the current demand and where all those people coming from overseas, the couple of 100,000 that they say are going to come every year, because they don't bring a home with them. But at the moment, a whole lot of shovel-ready projects that would have got going, a lot of those apartment towers, they're not financially viable at the moment. Developers are too scared to get going. They don't know if builders are going to go broke. They can't get finance from the bank. So we're coming into a period of even more undersupply at a time when overseas migration is going to pick up. And maybe one of the other things to remember is all those experts, like I said at the beginning, they got it wrong last time, not on purpose. It's just too hard. And most of the people who are giving advice on property or forecasts on property are coming from a share, an equity, a business background, not a property background. And maybe the last thing to remember is Australia's economy is doing okay. Unemployment is low. Anyone who wants a job can get a job. More jobs are being created. The government doesn't want a property crash. We saw during the pandemic, the banks gave mortgage holidays, mortgage relief, helped you out. They don't want to take over your property. And the Reserve Bank said they don't want a crash. They want to slow us down. So overall, this is just another phase of the cycle. Easy for me to say because I've been investing for close to 5 decades, so I've seen it before. But others who've never seen a downturn, and for most investors never seen rising interest rates, it's scary. Scary the first time and the second time, but not the third or fourth time you've been around the block, Nathan.
Thank you, Michael. It's been a pleasure having you today and giving a lot of our homeowners and investors out there a bit of confidence to know that this is all part of the cycle and things to expect. So thank you very much, Michael. And we'll leave some links below for our viewers so they can get in touch.
My pleasure. Thank you.